Alright guys, glad to have you on board again today. I wanted to record this monthly update in here because there's quite a lot to unpack. Of course, this might not be new to any of you out there, that lots of things have happened throughout the latest few days. And I sincerely apologize that I just simply couldn't find enough time to record earlier than that. The other apology comes from the fact that I also promised that I will get you some information around Armstrong's war cycle. But that as well, couldn't find the time to get you all prepped up before this actually happens, which means right now making it afterwards makes no sense to me because, well, no shit Sherlock, we're right in the middle of it. So the war cycle is playing out exactly as prepared for. But anyway, even if I couldn't find the time to record the podcast to explain all the details about this war cycle, you've got more than extensively prepared for it throughout the multiple weekly reviews that we do regularly on the TradingView channel. So nothing should be new. It's just I wish I could have gotten all the details beforehand because we're always going to look for the future and never talk about the things that happen right now. I'm a trader, not an analyst. So remember that these are two different jobs. The job of a trader is to forecast the future with no arrogance, and certainly no certainty about it. Remember that no one has ever predicted the future. So what I'm saying in here is just a mimic. It's just saying we need to play the game of predicting the future to make profits in the stock markets investing. But the thing is that we're also going to need to risk manage the moments in which we're inevitably going to be wrong. Because if you understood the first statement, no one ever is able to predict the future. So we need to try and risk manage the risk of being wrong. And that's the job of a trader / investor. So that's really one thing you need to understand. The duality of this thing, like the blind stupidity of trying to do something that's inherently impossible, but at least trying to do it better than just throwing a coin out there and just being right 50% of the time. If you can at least be 60-40, like 60% of the time right, 40% of the time wrong, well, at least, so long as you have a decent risk management in which you're risking 1-to-1 against your gains, you are already a profitable trader just by a 60-40 margin. Though if you can get even further than that, like my own statistics traced over decades, remember, I've been publicly expressing my sentiments and my trades for the last 10 years, and I've been trading for 15 years, and that's more than enough of a sample for you to figure out. And I'm generally above 70% chances of correctness. 70, 75, rarely more than that. That still means, oh boy, I am wrong 1/3 of the time. So I really want to state this obvious thing very clearly. That means whatever I'm saying here, and I've been saying in the past, has been accurate some way 2/3 of the time and been absolutely wrong the remaining 30%. So it is something you need to account before going any further with that video, okay? I am not some kind of guru or future teller of any sort. So again, I'm just doing my job in front of everyone to show to real people what the real fucking job of an investor / trader is. The risks that comes along with it, dealing with uncertainty, managing the risks in any given shape or form, trying to remain neutral at all times, and respecting a goddamn risk management strategy. That just can't be perfect because then no strategy can predict the future and no strategy can be perfect at managing risks either. So you need to deal with the best you can and trying to sort your way out of this through time. That's it. Though anyway, that was just pure introduction in here to make things straight and be sure that we're actually talking about the real things here. So let's get into it. Why do I do this monthly briefing? Because of course, yeah, a lot of things have happened. Have we prepared for it? Absolutely yes. Are these things happening relatively quickly? The answer is absolutely yes. So you should always be prepared. Remember that a trader that is catching up with things is generally a bad trader. So you should always be one step ahead of what you're going to do and just apply whenever things happen. So have we been prepared for this? Yes. Look at the weekly briefings. I've been preparing for this for several times now, even months or even quarters before this. We have assessed durably the absolute inconsistency within the ratio within the WTI to gold ratio. That was the metric behind that, the physical metric, the data metric that has been preparing me ahead of that scenario that I've been waiting for several times now, waiting for this to trigger. And we've seen that ratio actually pulling down and down, down, down a lot in the past. I think the last record of me talking about getting into buying oil versus gold was back in 25. So it's essentially a long time ago already. And we've gone much, much lower since then. The message is, once again, I'm not timing the market. I'm just building scenarios out of technical areas that would make sense. What I said back then is that the further we go, the more violent it would be the other way around, because we're also dealing against statistics. That this chart in here is more than 70 years old. It's a range. There is no direction on that thing. It's a stochastic distribution. So it's a classical bullshit. That means people will be bullish at the top and bearish at the bottom, where statistics say fuck them and do the opposite. So what I say is, in here we've gone absolute bonkers stupid in a way that we've gone beyond the 99th percentile, which means we've traded at extreme deviation, just like we know the future. Like oil is bullshit and the gold is the future, and gold is the future. And as I said, statistically, it doesn't make any sense to follow the crowd when the crowd is at extreme moments in time. More even so, we said the only time in history, in the 70 years history of that thing, where we've gone worse, like when you said beyond 99th percentile, still means we've gone further before. And the only time in history where we did was within COVID, where actually all the tankers were just stopped. No one was actually buying any of it, and the entire market was at a halt. So essentially, we were in a one-time moment in history that is the only precedent in which the ratio has gone further. And like I said, I don't see any world in which we don't use oil because we're all locked in our homes and stuff like that. It's definitely the same, not the same world today. So we're trading just like it was, and it wasn't. Like I said, something was wrong. And in this ratio, that means either the price of WTI is extremely underpriced or the price of gold is extremely overpriced. And like we said, it was definitely a combination of both, because people were hoarding in paper gold, scared of whatever bullshit. I mean, you can look at all the headlines that were printed just a few weeks ago. It's just basically that gold is the future. No matter what, they're always going to print their way out of this thing. So the only way you can survive the money printing is to buy gold. Most of the people weren't buying gold, physical gold. They were buying into stupid paper gold, just speculating to get rich quick. And it created a nasty, stupid bubble on top of things. Though certainly some fundamentals were right. Remember that certainly the central banks have been buying gold as they were lifting off of the dollar. And that is one thing I said is clearly a fundamental catalyst that isn't going to stop today. But that also means the central banks aren't just buying at any given price. They're buying into some prices. And I can guarantee you they're not buying any more now because it's just stupidly elevated. So the idea is that the prices have gone into stupid territory. Surely the central banks will buy again after some significant retracements, or at least some waiting. They have no reason to rush right now into an overcrowded, bullish, speculative market. So that's the message. Gold has gone too far, too fast. And it's probably going to have to either digest and wait for further support, or just blind out collapse to some viable territory. And oil, on the other hand, were absolutely mispriced. We have assessed also throughout the weeks that there is an obvious, visible price manipulation that has been made by US market makers because they've essentially overcrowded the market with paper shorts to the point that the market maker, who is generally the counterparty for the producers who are hedging themselves through the futures markets, were essentially controlling prices. So the brokers, who are supposed to normally be in the losing side of the trade because they take away interest and commissions, were actually controlling prices. Whereas on the same time, the so-called analysts were going into the television channels and so to tell us that we were in an oversupply, the supply glut narrative. And remember, this is bullshit. I mean, this is total incompetence. These guys were actually using the quotas numbers, which is far off from the actual deliveries and sales. So the real numbers weren't showing any increase in production, or very limited ones. And they were plotting out the numbers of quotas to say the market is increasing production all over the place as the consumption is going down. The reality was absolutely the other way around. And like I said, this would probably not last long. The best case scenario for these divergences, when the prices diverge from reality for various reasons. This one was an obvious price manipulation. It generally doesn't last much more than 2 to 3 years. So we said we're already 2 years in, and this manipulation price will probably pull the prices of oil back to the median part of the range. So this manipulation started somewhere across 23 all the way to 2025. Okay, and now, as we said, as we're gonna have to get back to reality, that's gonna push the price of oil back to where it should be all along, $75. That's where we are right now. And like I said also, is that $75 is the fair price of oil if we just unwind the price manipulation of the market makers. Like I said, the market makers have manipulated price, but they need to get out. They need to find some sellers so that they can exit their contracts. And like I said, this demand will push the prices back to where they should be all along, the $75. The problem is, I said, if anything comes out in the middle and fucks this whole beautiful story up by just essentially, I don't know, whatever, anything that push the fundamental demand and supply mechanics of oil into the opposite direction, like essentially fucks up the supply glut narrative. And I said, I have evidence of patterns that I look for with decades of provable history of statistical significance. Once again, not proving that they know the future, but Armstrong has been proving his statistical significance into forecasting the market. So this guy essentially said, well, I believe somewhere around March, something ugly is going to come from the war cycle. And I was like, yeah, war cycle, price of oil, fuck him. I think the two are going to be somewhat correlated. Hence why I heavily jumped into saying, fuck the markets, I'm buying oil on the support. And against everyone else in the consensus, I just bought the fucking support. Now we're back to the price where we should be just by pulling out the broker's manipulation. And we have the Strait of Hormuz that is straight up broken. And closed. So, like I said, I think we're going to go higher than that, not because the Strait of Hormuz or whatever, and not because the war is going to last for a decade or so. It's just because, blind simple, we're already where we should be just by the broker's manipulations and winding. Now, we're going to have to price in the reality check, which we're in, is that we're fucked into a war yet again. Is this war going to last 2 to 3 weeks and going to be stopped? I don't care. These are beliefs. Once again, we don't know that for now, and the only thing we know is that the reality is that no tankers are crossing the Strait of Hormuz right now, and we also have upward pressure risks on top of, because if you just look at it from the distance, you have a very asymmetric situation. Because, boy, on one end, we've got the United States and Israel. If you combine their military forces and you compare it against Iran's, yeah, we're like 91 against 1. So they're essentially having an overblown capacity of destruction against Iran. So if you think it's going to be a straight out war in which we're going to sink the other people's ships or whatever, this is not how it happens. It's going to be a dirty war if the war ever lasts. It's going to be the dirty kind of war in which you're going to see the things that dirty wars do, like terrorism, like sabotage, like targeting some highly critical infrastructure. Like, I think the risk right now, and that the market is understanding somewhat, is that, yeah, Iran is probably going to fuck up the infrastructure for oil production in the entire Gulf region. And it's not just about the Strait of Hormuz, it's about all the negative consequences that come along with it. And it isn't just sabotage. Like I said, you should be worried about some other nastier stuff like terrorism. So that's the reality which we live in now. That's a hell of a wake-up call. But the second message is that despite all of these things that I've said, I have a monthly fucking signal now on the WTI to gold ratio. And the consequence of it, the strategy, the technical risk limitation strategy, doesn't predict the future either. It's just mine has some very high detail and precision level, to the point that it could actually build strategies all on its own. And you can see the historical patterns are statistically freakingly good at relevance. So the thing is that we have a monthly signal. Anytime it happened on this chart, as you can see, rarely is anything but a bottom, and generally prices are higher 2 to 3 years later. The ratio in here means to me either gold is going to collapse or oil is going to be repriced upwards, or probably a bit of both. So that's the idea. And how long is it going to last? Well, the negative effect of it, the pressure on these prices, are probably going to last for the next 2 years. So what I'm saying is, even if this war is short-lived, I think the message, the mechanisms, the price mechanisms that have just been triggered are going to have negative effects on the price of oil against gold for the next 2 years. And it can go fast with momentum if there is a fundamental catalyst, or can go slow if just the price pressure is applied. So what I'm saying is, no matter what happens, either it's going to be quick and painful, or it's going to be long and duration. It's going to be long and lasting, and it isn't going to stop. There will be no way to stop it. Okay, you could delay, but it will happen anyway. So that's the message. Okay, now the consequence of it is that, as I've always said, there is also another scenario we're trading, at least that I am sharing with you, that I think the US economy is at a divergence. It's at a critical point in time where the trend has gone overextended. It's gone too long, and it's even starting to look a bit too much vertical due to some psychological patterns pulling on top of this. And one thing that have struck me hard the latest 48 hours is the resilience. Not the rest of the world. Remember, the rest of the world has done what it needs. It means most people were thinking the supply glut, blah, 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 growth, no lending. The market was in this kind of mood. I said I entirely disagree with it, and I have evidence that the smart money doesn't follow that narrative either. So I'm rather like to stand on the side of the smart money, meaning I am at least not following the stupidity, and I'm even actively trading against it. And we'll see who's right and who's wrong. Now, the idea is the reality caught up. And I was definitely forecasting that we would get a wake-up call such that one. Or even less than that would have been more than enough. So this one is quite a big one. And we're right in the middle of it. And though I was expecting that the S&P would brutally call back to reality, even more brutally than the rest of the market, because the rest of the market has already somewhat been volatile and managing risks, even though asymmetrically still been managing the risks. The US hasn't. I mean, the US is essentially straight line up. Bullish, baby. Nothing, no volatility, everything is crushed down. So I was like, oh boy, this wake-up call, it's not necessarily a black swan, because a black swan is something that no one ever saw coming. This one, quite some people saw it, or at least a minority, but some. So it's not a black swan. It's somewhat of a gray swan, an in between, but it still has some real world implication and impacts. And the market just shrugged it off. Like, it barely retraced 2% the first day. The day right after, we're already V-shaped reversing. Like, what the fuck is going on? So I was like, yeah, something is wrong. So that just called me into, this is definitely psychological. And it just reminded me that, well, that's where we are. I knew that there was a psychological pattern play in the US, but it just reminded me that we're now switching gears. So that's the important message today. This psychological pattern is at play for nearly the last decade or so. And it's about to switch into the less pleasant part of it. And we've just gone to switch from a very important moment in that pattern. Because I believe back then, coming out from the Ray Dalio's vision of the market, so much longer dominance pattern of 100 years or so, with the US dominating the world order, and the fact that it also foresee that they're in the descending part of that, and therefore they're starting to experience all sorts of negative emotions. What I'm saying in here is that on top of these long-term, like century-long kinds of things, investors have also been adding up a more dangerous short-term amplification of it. So surely the long-term investor in the US are biased with Ray Dalio's version of the thing, that a long-term cycle. I mean, every investor alive today has basically only experienced the US dominating the world. So they haven't experienced any different. Anytime there's a problem, US is either printing money to get out of it, or exporting the problem elsewhere, because it's always worse out there. So it's always like anything that happens, it means the dollar is a safe asset. So every money flies back in the US and so on. And I think every investor right now, mostly US investors, long-term investors and professionals, are totally biased because this is the only thing they've ever known. This is the only thing they've ever lived through. When shit happens, money flows back to the US. And I think this is a total misunderstanding of how things actually work in the long term. This is a biased vision, and Ray Dalio explains it very straightforwardly. But there's another pattern on top of it. And this pattern is even more dangerous because this one touches on the retail side of the equation. It's the bubble pattern. The bubble pattern is, once again, a cyclical behavior. It means it has a positive oscillatory signal and then a negative oscillatory phase. And the thing is that I think we've just crossed from the positive to the negative phase. This is the moment when I call we've gone from decadence to arrogance. Because decadence is all the positives that we had. Essentially, US has always been the leader, blah, blah, blah. And then we've had some more dangerous stuff on top. Because it's no longer institutional investors who are trading in the market now. We've seen the public getting in. Specifically, to me, the turning point was when we get a lot of media attention from the first Trump mandate, when essentially no other president in history has been calling in the Dow Jones levels every week on their social media, but the Trump administration and Trump himself did quite a lot of it. It's been bringing a lot of people into the stock market with not a bit of experience at all. So these people came along in 2017, 2018. Then came in the enthusiasm. Remember, Trump has been fueling the market with more fire. He's been overheating an economy, ultimately culminating into the COVID pandemic problem. The problem is that enthusiasm, instead of being caught up with reality, that it was just fueled by the reckless monetary spending of Trump and the fact that retail traders were getting into the market without experience, essentially learning that it's just bye baby. Its stocks can only go up, and if things terrible happen, we're gonna just print our way out of it. That's the message that COVID sent. That even when shit happens, get fucking greedy. They're gonna get your ass out of it. And that's where things gets dangerous, because no one risk manage ever again. It's just, yeah, no matter what happens, they're gonna risk manage for us. And then comes the very dangerous phase. That's delusion. That's essentially what we're in since 2022. That means we've seen the aftermath of the COVID pandemic money printing. It's been inflation, real world things. We should have been cutting up with reality back then. But instead of rejecting from greed, no, we've gone total delusion. Like, we're going to find another thing that's even bigger. It's going to save us. It's the AI thing. Remember, AI is the future. Surely, I'm pretty damn sure AI is part of our future. But right now, people are just absolutely bonkers stupid with it, to the point that delusion is just absolutely there. But the problem is, like I said, this was just a model I kept in the back of my head. Like, are we really going into one step further and one step further and one step further? But the turning point is the more important phase. I can definitely agree to the fact that delusion is already in the past now, because we now move to denial. And I see the denial right now in the market. The denial is exactly what we've seen throughout the latest 48 hours. That means despite the call to reality, now we have the fucking war. We have the president who said we're never going to get involved in a war. Blah, blah, blah. He is right in the middle of one. A war that hasn't been even dragging him in. He decided to go there. It's an absolute stupid decision. And now it's the reality. We're in full denial. The consequences of it are going to hit the US more than anyone else in this world. Yet, what are they doing? They're saying, yeah, the energy supply is going to be even more damaging for the Europe. So let's just sell Europe. God fucking damn it. These are the mechanical misconceptions that every US investor is playing with now, because they've been so goddamn used to it. They've been like programmed to think it that way. They're in full denial, not because they can't see, not because they want to, they just can't see it. It's so damn deeply printed into their way of thinking that, yeah, for them, the US is always going to get out of it. It's always going to be the best in sorting the shit out. And they're always going to look for worse situation out there. And they're actually saying, yeah, Europe is going to take a lot of shit, blah, blah, blah. And in the US, capital will fly back home. And we're going to get a shitload of demand for dollars. That's what I see everywhere right now in the US. And it scares the fuck out of me, because it just tells me now we've switched to arrogance. Like, there's just no way for them to see. There's just no way for them to question the narrative anymore. It just feels so obvious. It's just the future, bro. It's what's going to happen. And good luck with that. You're in full denial. And if I'm correct, the next stage is going to come relatively quickly. And that's a bull trap. That means we're going to fuck up a support, and fuck it up very clearly. We're going to send the monthly top signal I'm looking for. And that doesn't mean it's going to happen now. Let's make it straightforward. The S&P is right here, right now on the monthly chart, is ready to print the signal. Just yesterday, before we attempt this rebound, I had the signal on the indicator. So I know for sure that whenever we go down, the signal will be there. It's just for now, we're waiting for it to happen. Surely we can spend another couple of months before we actually send it. We're in full denial. So remember, this is psychology alone now. It's going to trigger, I know for sure. At least I have high conviction and probability of this because so many patterns converge into the same area. Though it certainly doesn't predict the future, remember the warnings that we said as an introduction here. It's really critical to think it through. But the thing is, there's so many things converge that the statistical asymmetry is just so high that I'm going to take profit of it. It's just such a hedge. I have a psychological hedge. I have a technical hedge. And I've got a fundamental risk management hedge over the situation. And it tells me that the three converge for the US to be the actually most damaging economy on the aftermath of whatever is happening now. And I see some people who are entirely convinced of the opposite. And I would like to say, I'd rather like to be in my position because I think my vision is a lot clearer and not biased against those who have, because I can't see their bias. I can justify them and I have pattern to exploit them. Though the message here is not, I'm right, they're wrong. It's really not about that. It's about if you can at least, if you are an American citizen, just conceive the fact that what I'm saying in here is not only probable, but highly likely. And if you could just at least make sure that if you get into feeling the bias, because you're probably not going to be able to fight against it, it's so deeply anchored, but at least making sure that you won't have financial consequences of it. Like at least disengage for the negative part. You're probably going to feel the emotions anyway, okay? You're going to have to feel them. Remember that there's no way for you to have experienced the positive angle and to just shrug off the negative part of it. You're going to get to live through it. But at least make sure that the financial consequences are not going to come along with that. Because the bull trap, return to normal, fear and capitulation, surely bull trap and return to normal can still be somewhat managed with a little bit of a drawdown. But the fear and capitulation and despair, if you're falling in for it and if you're financially exposed, it's not going to be pretty. It's not going to be pretty at all. So at least make sure that you keep some of what the things that I said today at the back of your head. You might not be trusting me today because you shouldn't, but if you start to see the bull trap, the return to normal, at least disengage before it's too late, okay? So that's the message. Okay. And though if it happens, what is it going to look like technically? Because once again, psychology is very hard to describe in critical form. So I'd like to put a more critical angle in here, something that you can dispute. If I'm correct, what's going to happen is the calling back to reality, like the bull trap. The bull trap is just breaking a support, questioning the narrative, and it's going to be fiercely met with the same opposition, and even worse than that. Remember that denial is like, we should be going down, but we're not. Bull trap is, okay, we've gone down, but that's a hell of an opportunity. Now, like I said, where do I think there's an opportunity of a lifetime in the US? So it's just pulling back to the previous market top, retracing to the neutral areas. I think that's where we're going, 6,100 or so, and I think this is where the bull trap will start to settle. So what does that mean for me in actual practical trading application? That means I'm not going to take profit there. I already have sold the market top. I'm not looking for the perfect moment at which it will trigger. I don't fucking care. Remember that when you're short, you're actually being paid to wait. So I'm actually profiting for time. So I can be patient in here. I'm actually paid to be patient. So the action is, when we get there, normally I would take my first profit taking. I would risk manage, pay for my stop losses, and that's it. I'm not going to do any of it. If I'm correct, this is going to be the bull trap. So the drawbacks, the rebounds will be very short-lived, very limited, and very narrow. So what I'm going to do instead is I'm going to reinforce every fucking pullback on crap out that is going to try to go up. I'm going to apply the pattern. And the worst comes from the fear phase, okay? Not the bull trap and return to normal. But if I see this, like if I see everyone getting suddenly very bullish on the US just because we've retraced 10%, I mean, once again, let's just be rational and put some numbers out there. That means the S&P would be losing 10% when the price of oil has popped from 20%. So it has an immediate effect on the economy, but they're going to say, yeah, you know what, AI isn't related to energy. It's such a compression on the future. It's going to provide trillions of dollars of profit, blah, blah, blah. Good luck with that. So, buy more AI if you want to. I won't. Though I will sell again if I see the market trying to stabilize and pretend that it is gone to normal. I wish actually that the war is terminated at that point. The war is probably going to be over and people say, okay, it's just another thing in the history of market, yet another drawdown. No, I'm going to sell the fucking crap out of every rebounds. The problem is, if I'm correct, fear is next. Fear is, to me, we're going to get into the illiquid area. This is where things start to accelerate a lot. This area is fucking illiquid. There's going to be no one to buy there from the smart money. The smart money in here is actually going to start increasing shorts, so at least make sure you're not buying there. But the idea is, get yourself fucking out of here before that moment triggers, because it's going to happen fast and it's going to shift the narrative. This is where the real negative emotion starts to kick in, because the scenario just doesn't happen the way it's supposed to be. If I'm correct in this area, you're going to see circuit cuts, circuit breakers in the US. The stock fucking market will stop operating. You won't be able to sell. The market will drop from more than 10% in a day, and you won't be able to do anything about it. When you wake up, the liquidations will happen as a consequence, which means the market will even open for 10 minutes and be closed again. All the cascading liquidations will trap all the retail traders, who will fall into capitulation, and after the capitulation will only be met with despair. What does that tell me in a kind of psychological pattern? Is that I've already had this pattern all lined up with other models. So the convergence in here is just crazily staggering. What that tells me is that I'm not going to buy after the liquidations. I'm going to wait for despair, and I'm even going to wait lower than I wish I should, which means it's probably going to be extended in the duration. After the liquidation, I expect, of course, some retracement. It isn't going to be that much of a retracement, but the phase of despair is probably going to happen afterwards. And the problem is, that means to me, I think we're going to have to trade below a major psychological support to create that despair. Remember, that's the desert crossing phase of the market, when you're actually not moving at all. Just like I played this game in 2018 with the bubble, the psychological bubble that was into Bitcoin. I prepared you for every fucking step of it. And now I'm going to apply the exact same thing to the S&P 500. I will buy that shit again, because there's certainly some value to be created in the US. Somewhere around 28 to 33, there's probably going to be a lot of value created out there. But the problem is, I'm going to buy it cheap, because I know we're going to get below the value. I think the long-term value of the S&P right now is somewhere there, but I'm going to buy below. Because like I said, I think the pattern is at play. And so long as it is, and the next step is validated, I'm going to play just according to the plan. Okay? I don't know anything about the future once again. All I'm saying is, so long as the pattern plays out, I'll play according to this. Okay? That's the message. Now, last but not least, because we're already 30 minutes in, and there's been a whole lot of messages around the cryptocurrency correlation. Because people essentially told me, well, if the stock market goes down, then what the fuck with crypto? Are we left with another 2 to 3 years bear market? And no, I don't think so. So I'm going to argue about that immediately. If you've understood the value crisis, and the thing that I've essentially said in here is that the world is about to change. And like I said clearly in there, it's probably going to come from a call back to reality with the physical limitations of our planet. And like I said, I think energy prices are the best that could ever trigger this. So we're right in the middle of it. Like I said, the war in Iran is just a trigger. It might not even be the thing that we keep in our memory in the long run. It's just, it would have been the trigger, because it triggered a call back to reality. And the consequences will be a lot of events unfolding one after another as a consequence. Of course, once again, if I am correct, I can predict the future, and I have 2/3 probability of making it right and 1/3 to making it wrong. So certainly don't bet your entire life savings on this. But that's the idea. If I'm correct with that thing, we're going to cling back to everything that is real, that is useful, and that is necessary on a day-to-day life. And like I said, I think cryptocurrencies in the world of AI and in the world of a totally blown up financial system that is starting to crumble on the way of debt and money printing, oh, surely it's going to cling back to crypto. Because like I've always said, that's the number one use case for crypto. When the shit happens in the real world and people cling back to safety, but the safety isn't the trust me bro stuff of the financial system, it's surely going to cling back into crypto. So I think whatever is about to happen is going to be absolutely benefiting crypto. But not all crypto, because some of crypto is actually under this influence as well. Because remember, the US president has been shilling Bitcoin just like every other shit going out there. So it certainly has a lot of psychology in it. And I think Bitcoin is going to follow some of that. It's going to be negatively impacted by this. I don't think Ethereum will, because as you've seen, Ethereum, has it pumped like the president was shelling it? No, it wasn't. So it isn't going to impact some assets. It's going to impact some others. Which ones? Well, anything that has been correlated to Bitcoin lately. So the Solanas, the Ripples, and those things, they all have one thing in common. They're heavily anchored towards the US, either because their foundations is in the US, or all their team members are in the US, or because they cocksucked the Trump administration to get into the tiny paper list and short list of US crypto firms. These have rided their way up. Remember, when you've taken the good side of that thing, you're going to take the negative side of it as a consequence. You can't get one without the other. So whoever has been profiting from the 2024 artificial bull market isn't going to be bullish in the following years because it's going to be slowed down. The one I said, it's going to be met by two opposite forces. The positive forces of crypto real adoption, like real growth, real utility. Not speculative and I'm going to buy 20x more than what I could afford with leverage. No, it's going to be just people buying into fucking Ethereum because they're going to say, oh, maybe this thing is useful. I should probably get some. That's just the thing, okay? People are going to buy it because they need it, not because they just want to get rich quick. So it isn't necessarily going to be the blow of the things that you got used to. It's more like a slow grounding growth, probably much more institutional driven than retail driven for the tokens that have real utility. So don't expect things to blow off rapidly. I think more of a slow grinding, silent in the background, but still going up, when still the rest of the economy and the S&P is going down. So I expect a negative correlation in the long term. But one thing that people don't get correct about correlation, and I really want to argue about that because some of it is right, but some of it is wrong. But you need to understand the difference between the two. If you're essentially like looking at NASDAQ, and you're studying the correlation between Ethereum and the NASDAQ, because that's an argument that I've seen coming out recurringly. And it certainly is true. As you can see, there is a positive correlation between the two. But people tend to say, though, that if the stock market is going down, there's no way Ethereum goes up. And that's totally wrong. What it tells you is that there's no way the Ethereum goes up right when the stock market goes down. That's all the correlation says, that the two are moving along together in terms of direction. But it doesn't belong to anything related to amplitude. That just means they have to go up together and they will go down together as well at the same time. And even though you see this correlation is degrading, so this is really not necessarily statistically viable anymore. But one thing that really you need to understand is that we could have a stock market that is directionally going down, like peaks and troughs going to the downside, whereas on the other hand, the very same correlated asset is making the same peaks and troughs duration at the same time with a high degree of correlation, of synchronous correlation. Still, this one will make a lot higher highs and higher lows, as the other one will do exactly the opposite. Yet they have a positive correlation. So correlation isn't causation. It's just statistical correlation. That's all there is, okay? So this argument of the positive correlation, yeah, surely is. But first and foremost, it's degrading right now, so it might not last. And it is not causational against the direction of the asset in the long run. Okay, it just constrains the momentum, the timing. Okay, that's all there is. So what I said, if I'm correct with the value crisis, anything that is useful and needed and demanded, like energy is the thing you just can't get rid of. You're spending it every fucking day. Like your financial assets. If you are scared that your bank is actually over leveraged in the credit system, in the shadow banking, and in the dark pool systems, and in the private credit bullshit that we're in, you might just say, yeah, you know what, I would like to have at least a tokenized asset. So, or anything. It's just a kind of security. Just, I don't want your trust me bro assumption. Just get me something better. And like I said, this is just blindsided huge immediate demand for cryptocurrencies, not as a speculative vehicle, but it's just as a useful thing that has been lying behind all along, the blockchain technology. The safe haven asset of Bitcoin surely I think is going to play its game, but the problem is, once again, we have all these fucking over-leveraged kind of guys like the Michael Saylors and the like who are going to have to exit. So there is a lot of sell pressure to be met for Bitcoin, but the demand is surely going to be there. And as you can see, the signal is there as well. So I don't think Bitcoin is done for this cycle, but I don't think there's room to the 250K or whatever magnificent targets we've been pulling around. But is Bitcoin in a bear market? No, I don't think so. But is it going to have some headwinds to slow it down? My answer is yes, absolutely. Now, when it comes to the rest of the crypto cycle, like I said, the Ripples, the Solana, everything that has been pumping out of nowhere for obviously shady narratives that has a lot of financial ties to the US, with either leveraging a lot of US VC money and all sorts of things. This will not be just a slight headline. Like I said, the US economy will come to reality. The reality check is that it's probably, according to Ray Dalio, the next stages are not going to be pretty. That's going to be people fighting against each other, and that's going to be debt restructuring. So I think, well, you shouldn't be very, very happy about holding a whole lot of very, very leveraged crypto hold with a lot of VC money that will just have to get their money out. So that's the problem. Some tokens will face both psychological pattern and financial coming back to reality problems in the crypto sector. Get the hell away from them, because even if they are actually useful and demanded, they will face even more headwinds than the actual demand, because the demand this time around isn't going to be 2021's demand. Let me just take Ripple. No, Ripple. Ripple is the shittiest example. I think let's just take Solana, because Solana at least is useful. The one reason why I think Solana isn't going to go all-time highs ever again is just for those reasons. I think the Solana token, it's surely a good token. The blockchain is probably going to be used in the future, not necessarily for really worthy usage, because none to judge. I think this is like the crappiest blockchain ever. This is where you're going to get all the gamblings and prediction market shit. But nevertheless, it's still useful to humanity. Not my way of seeing things, but the reality isn't just my way. Anyway, so the idea is this. You need to understand that I think Solanas and the Solanas alike, they're not going to go down. Surely the utility is going to get back in. But the problem is headwinds are going to be significant, because there's way too much speculation in here. All the retails, the US retails who bought it in 2024, they're going to have to sell. And like I said, all the VC money who's been pumping this project all along are going to be forced to sell as well for margin calls. So, like I said, I think these very US-centric projects are not going to be very, very bullish. Not bearish either. Like I said, I think Solana could be a good buy there. But the problem is the risks you take is exactly the same as it is for the others. But the problem is the rewards you could rip out of the risks you take are much smaller, for the reasons I have explained. So this is it. Once again, I try to wrap it all up. I think there's just one, there isn't just one simple answer for everyone. The answers are always a bit more complex. When it comes to the US, like I said, I don't think the entire US economy is coming to draw down. I think the defensive part of the US, which is already trading like the recession is in, it's probably not going to go much lower. Just like some cryptos have gone back to fair value. And remember years ago, I told you exactly we'll get back there. So don't rush into buying the highs. Just, well, you want to buy some Solana, buy it now. I just think there's much more worthy buys to be made now by buying into Ethereum or Cosmos and things that have been absolutely hammered and have not an ounce of US VC money backing them. These, I think, are the token that if they get used for their usability, their usage, they will probably go back up in price. Are they going to go surging all-time high like 2021? Baby, certainly not. So that's the understanding. Go for utility, okay? Go for utility and be patient. It's not going to be dumb money buying and ripping through every resistance. It's going to be smart money buying for the utility and slowly accumulating, not breaking into resistance like momentum is crazy, okay? And it's probably going to follow the cyclical behavior of the stock market, which means if the stock market is going down, don't expect these guys to break resistances. But you expect these guys to retrace back to support, and you want to be buying those supports. That's it, okay? Now, when it comes to the US, like I said, if you have some defensive exposition, surely that's fine. Don't expect to make tremendous rewards within the next few years. We're probably headed for recession, and it's probably going to be inflationary. So if you want to be spared in the meantime, like you don't want to be among the speculators, stock picking or whatever, the easiest thing to do is to buy energy and to buy commodities. So you at least hedge against inflation. You're not going to be making any fucking profits, okay? The profits you make are going to be the financial dilution of whatever money printing eventually comes away. So that's the idea. Protect yourself against potential money printing. Because one thing is for sure is that the money printing could very well be a thing. We have been constraining liquidity for months. Remember the banana guys that told you liquidity will be flooding the market. The reality is they bullshitted you all along, and and none of this actually happened. The net liquidity has been drained out of the system for months and years. But it's surely going to get back in. Not in limited liquidity, but expect $2 to $3 trillion to be printed. It's probably going to be to save the economy rather than fueling your stock market portfolio. But that's it. And it's probably going to create inflation. As we said, as a result, the number one consequence is every dollar spent is going to be scrutinized by the market and immediately printed as inflation. So it's not going to be outrageous money printing as it used to be anymore. This party, this game has ended already. And I told you that multiple times. Oh, once again, I could be wrong, but I think I am not. So that's the idea, okay? Hedge yourself against inflation and consider it the best you can do. Don't try to be profitable in such an environment. It's really way too dangerous and require real professional skill set to stock pick and be very patient and also be able to time the market, which is the most difficult thing to ever do. Otherwise, just get away from the short-term noise. Understand that you rather like to be at least away from the US market or bearish in it because a lot of negative consequences are going to come along with it. Okay? If you're playing this game, understand as well that valuations can go up, but that's always going to be at the expense of the currency. So you need to understand the currency devaluation mechanisms if you're getting yourself into shorting the US. Okay? That's essential. If you don't know anything about it, just don't do it. Okay? The other things, like I said, hedge yourself against inflation. So commodities and energy feels like a safe play. Just because if there's no inflation, they won't go much higher. You won't make profits, but there will be no inflation. So you can at least store your cash there for a limited amount of time, and then you can safely reinvest within the next 2 to 3 years once the negative consequences and effects of these will be wiped out. Once we've terminated the cycle, there will probably be a very worthy investment timing. But God knows which world we're going to live in at that moment in time and which sector we're going to have to invest in. All I'm saying is, you'd rather like to wait for that moment to make that decision. So that means right now we should rather delay any financial investment decision for 2 years and let the thing pass. Let the negative emotion get through. Just don't be in and wait for the things to unfold. When it's been unfolded, we'll have probably a slightly different world, far less hyped around AI and shit like that, and this would probably be the best moment to buy new things. Okay? So that's the message. And in the interim, just try to be smart enough not to get hurt, and just try to be smart enough not to try to make $1 million out of it. Okay? When it comes to crypto, be patient. Be smart and look for utility. Don't look for hype, don't look for momentum, because I'm pretty sure some individuals, very US-centric and along, will try to ride the bullish cycle by doing the same old price manipulation, aka using limited supply and using pumped leverage to pump and dump these things. So be very cautious. Anything that is US aligned in crypto is dangerous. If you're buying because it pumps, you're getting into a trap. Okay? Look for the things that don't do this. Look for the quiet. Look for the things that build. Look for the things that have provable utility and on-chain, non-manipulable metrics. Okay? So be very cautious with all that. If you don't know how to do any of it, I'll be there every week to always try to help and guide. Not to tell you what to do, but to tell you what I do and why I do it. Which means at least you'll have a base of knowledge. Then please don't just blindly copy what I do, but at least try to take some valuable information out of it. Okay? At least I hope today was worthy listening to, and I'm going to leave you guys with that. Bye-bye.